Okay, can you understand it? Yeah. Okay. So that's about that. So you understood this thing, right? A picture perfect example of this thing. See that? A picture perfect example. Fake trend lines, fake order blocks, fake reactions. But where did we enter? Right here. Right here is where we entered. Okay. So this is that. And then let's get into market structure and trading ranges. Okay. Because identifying your proper trading range, your current trading range will be very important. Okay. Identifying your current trading range, like constantly marking out your trading range, because every single time frame will have its own trading range. Okay, now the 4-hour trading range might be bullish. Okay, but the 15-minute trading range might be bearish. Okay, and the 5-minute trading range might be bullish once again. See that? And the 1-minute trading range might be bearish. Okay, so how are we going to use all of this? So if you identify the proper trading range, you can use all of it. Okay, you can use all of the trading ranges. So I'll show you how to use all of that. But before that, give me a second. I'll just have some water and come. Okay, give me a second. Okay. Can you hear me, bro? Yeah. No. Can you hear me? Yeah. Okay. So far everything is clear, right? Let me know, because until you get clear, I will teach this thing. Don't worry about that. Okay. So is everything clear so far? Yeah. Okay, then let's get into market structure and trading ranges. Okay, now when we say market structure, now everyone will be like high highs and higher lows, right? But if the market moves this clearly, then everyone will be making money out of the market. Okay, so it does not move that clearly. Okay, it does not move that clearly, but let's use the same thing and I like understand why high highs and high lows are made. Like you always have to know the logic behind what's happening, right? You, that's the thing. If you know the logic, if you know the reasons behind why these things are happening, then you will know like where to enter and where not to enter. Okay, so that's the thing. So let's use this as the same example and see the reason why higher highs and higher lows are made. Okay, let's see the reason why it's made. Okay, so then let's see an uptrend. So let's say price is doing this: higher highs, higher lows, higher highs. Okay, so let's say we are in an uptrend like this. Okay, price is creating higher highs and higher lows. Okay, higher highs and higher lows. So remember, after every single break of structure, a new trading range will be created. Okay, so we have this break right here, and we have another break right here. Okay, this was actually a minor break. Let's delete that. And we have another break right here. Okay, we have another break right here. So let me move it here. Okay, so after every single break of structure, a new trading range will be created. Okay, a new trading range will be created after every single break of structure. So everything that I show you here is applicable on any time frame. Okay, it is not just limited to higher time frames. This is applicable on any time frame. So that's the thing. Like if you do not want to do this whole top down analysis and stuff, you can just play based off a lower time frame trading range. Okay, you don't have to spend hours and hours on a chart. Okay, you can just do a little analysis and play with the lower time frame trading range, but keep in mind it's always risky if you do not know the higher time frame trading range. It's always risky. Okay, but yeah, now let me show you this. So we had this low, from this low to this high, and from this low to this high. So your current trading range is from here to here. Okay, so what do you do when you get a new trading range? You have to look for discount and premium prices like this. Okay, because it's like a normal market. It's like a normal market. Now, if you want to buy a product, what would you do? You will wait for the price of that product to decrease, right? You're going to wait for the price of that product to decrease, or else until it gets into a cheaper price. So same thing here. Okay, same thing in this market. You have to wait until prices get cheaper. Okay, you have to wait until it drops into a cheaper price, or as a discounted price. Okay, now when I say a discounted price, it doesn't have to necessarily drop down into the 61.8 or into the 70.5 or into the 78.6. No, no Fibonacci retracements are required. If it just taps the equilibrium, that will be enough. Okay, so like no Fibonacci retracements are required. So a high probable bullish point of interest will always come from the equilibrium, or else anything below that. Okay, from the equilibrium or else anything below that. We're not going to look for any points of interest above the 50%, above the equilibrium. No. Okay, we're not going to look for anything out here. Now for sure they can move this, for sure that can happen. Okay, like they can do that for sure. Okay, because why? They do whatever they want to do. Okay, but we are not trading this, because why? It's not a high probable setup. Simple. Because it is not about trading every single move in the market, right? It's about trading the high probable setups, the setups where you can easily risk your money on. Okay, but these are very risky setups, right? Because what if they do something like this and quickly if it drops back down, you're taking a loss. You're taking a loss, right? So we have to always wait until it comes into the equilibrium, or else anything below that. Anything. Okay, so that's about that. So let's say we have the discount and premium prices marked and price is dropping back down. Okay. Now, what's the second reason they are dropping back down? It is to take out the internal range liquidity. Okay. The liquidity that is resting inside of this trading range. Okay. The liquidity that is resting inside of this trading range. Now, what is the liquidity? Now, first thing we can see on this same time frame itself, you can see swing lows forming, right? Like, do you know the three candle formation for a swing low and a swing high? Yeah, the three candle formation. No, let me show you. Okay, for it to be considered as a swing low, okay, for it to be considered as a swing low, it like always take three candles, choose three candles. Okay, now like this is all you need to see: a higher low to the left, a higher low to the right. The middle candle becomes your swing low. Okay, the middle candle becomes your swing low like this. Okay, all you have to see is a higher low to the left, a higher low to the right, and the middle candle is your swing low. Okay, the middle candle is your swing low. So that is all you need to see, a swing point. See, now look, because understanding this will be very powerful, because this is where the breakout traders are going to have their sell stop set. Okay, so look at this: swing low, swing low, swing low. All of these are swing points. So look at all of the liquidity in the market. In this little bit of price section, look at all of that liquidity. See that? All of these will be considered as swing lows. See? All of them. All of them are swing lows. See, even this. Why? Higher low to the left, higher low to the right, swing low. High low to the left, high low to the right, swing low. High low to the right, high low to the left, swing low. Okay, so this is where liquidity is getting built up. See that? Can you understand that? Yeah? All of that liquidity. Okay, so that is a swing low, and same thing for a swing high. Okay, it has to have a lower high to the left, lower high to the right. The highest candle becomes your swing high. Okay, that becomes your swing high. See, this is a swing high. So same thing, a lower high to the left, lower high to the right, swing high. Okay, that becomes your swing high. Even this little candle here. Why? A lower high to the left, lower high to the right, swing high. Okay, swing high. See, all of these are the areas that has buy stops above it. See that? Buy stops. Look at all of the liquidity in the market. That is why it moves this aggressively. Look at all of this liquidity. Now, yeah, now most people, when I say swing highs, okay, they will look for only the, like, yeah, only for areas like this. Now, when I say swing highs, most people will look for only these areas. No, those are not only the swing highs. Okay, the three candle formation is all you need. See that? This is all you need. Now, what happens? Every single time they run below a swing low, okay, look what they do. Goes below that, activates the sell stops, pushes back up. See that? Activate the sell stops, pulls back up. Even from this swing low, see? Activates the sell stops, pulls back up. Look at this. Every single time. Activate the sell stops, pulls back up. Okay, so this is what happens. This is what happens. Okay, so even here, activated the buy stops, pulled back down. And then once again, what happened? Activated the buy stops, pulled back down. Okay, so this is what they do. This is what they do. So the swing highs and swing lows are very, very, very important. Okay, in terms of market structure, in terms of liquidity, and all of that. The three candle formation. Okay, so yeah, you have to get used to looking at it that way if you were not already looking at it that way. Okay, so yeah, now inside of this time frame, inside of the same time frame, you can see these swing lows getting formed, right? The three candle formation inside of this trading range. So that is where the sell stops are. Okay, that is where the sell stops are. So when I say internal range liquidity, all of these swing lows that are resting inside of this trading range will turn into internal range liquidity. Okay, internal range liquidity. So the reason they are dropping back down. So keep in mind, a drop in a bullish market is a hunt for sell stops. Okay, a drop in a bullish market is a hunt for sell stops. So price comes back down, clears out the sell stops or as the internal range liquidity. After taking out the internal range liquidity, where will they go next? They will go after external range liquidity. Where is the external range liquidity? Right above this high. Okay, or else after taking out sell stops, where will they go next? They will go after buy stops. Where are the buy stops? Above that high, like that. Okay, so then you can see a high low and a high high. Okay, so can you understand that? Yeah, let me know. Is everything clear about this? Do you have any other doubts? Yeah,
See, I have one doubt.
yeah,
Can you? I will use the annotation tool.
okay.
Mm, can you see this?
Um, yeah, I'll see that only after like 5 seconds, I guess. No, I can't see it.
Uh,
Ah, yeah, 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 I
okay,
can see it now.
okay.
Yeah, yeah, I can see it.
See, all these were the internal range liquidities, right?
Yeah, yeah, yeah.
Um, so the thing that confuses me about this thing is, um,
Okay. Sometimes price will go up without clearing the internal range
yeah,
liquidity.
yeah, yeah,
Is
yeah,
that
yeah.
the problem?
So
Yeah, I know that's your
how can
problem.
we identify that?
Okay, okay, I'll show you. I'll show you. Now have your drawing as it is. Don't delete it. Okay. Now I told you. Ah, you did it. Okay, it's okay. So let's say we had it this way. Okay.
Okay.
So I told you, right? Discount and premium prices
Yeah.
like this.
Mhm.
Okay. Now this is the thing. Now let's assume this is the 4 hour trading range. Let's assume this is the 4 hour trading range.
Okay.
But inside of the 4 hour trading range, you might have a daily point of interest like this. See that?
Okay.
Last push down before the push up. So this is a daily point of interest and it is in a discounted price. See that?
Okay.
It is in a discounted price. So then this internal range liquidity is being fed into this point of interest. So it's high probable, right? So price can do this. They can come back down to this and then go up like this without clearing this liquidity out. Why? Because there was a higher time frame point of interest here. Simple. See that? That is the reason why they don't come back down all the way into these areas all the time. Like sometimes they do, sometimes they do. Okay, but what if now? Most of the time they clear out all of that when there is a lot of liquidity, like trend lines like this forming, then they will clear out all of this and then tap into this. because we can't look for any POIs from these areas, right? Why?
Yeah.
A lot of liquidity, a
Liquidity.
lot of liquidity. So then, yeah, so then they can clear this out. But sometimes they can go from here without clearing out these lows, because why? This is a higher time frame point of interest inside of this lower time frame trading range. So they can tap here, clear this internal range liquidity into this point of interest, and then go up. See that? That can happen. That can happen. Okay, so that's the reason why I asked you to look for discount and premium prices.
Okay.
Okay, so is it clear? Is it clear? Yeah, I know your question before you ask it, because everyone asked that. Okay,
Yeah.
so yeah, then price can drop back down to clear out the internal range liquidity. So after clearing out the internal range liquidity, where can we expect price to go next? External range liquidity, right? Yeah, like this. After taking out sell stops, they will go after buy stops. So took these sell stops out, then you can expect the buy stops to get taken out. Simple. Okay, now, but how do we confirm that a new trading range is created? Okay, how do we confirm that a new trading range is created? Now, this is the most important thing about trading ranges. Okay, keep this in mind. This is the most important thing. So let's say we had a strong low created. So internal range liquidity is taken out. And after that, where will price go next? External range liquidity. Okay. So now let me mark out the swing lows too. So let's say price is going up like this. Let's say price is going up like this. And only once you get a break outside of this trading range, okay, only once you get a break outside of that, you can consider this as your strong low, or as the low of the new trading range. Okay, the low of the new trading range. But how are you gonna mark out your high? So you can't take your high from here to here. No, you can't do that. Okay, there's a way to confirm the high. So for you to confirm the high, it has to give you a break of structure in the opposite direction. See that?
Yes.
Only once you get that break of structure, this becomes your new trading range. So see, higher highs, higher lows, higher highs. Okay? Only this break of structure. This is the most important thing, the break of structure in the opposite direction. Now, when I say a break of structure, I mean a swing low. You saw the swing low, right? A swing low getting broken. That's it. The three candle formation getting broken. That is all I want to see. Okay, after breaking out of this high, I want to see a swing low getting broken. That's it. Now, when I say a break of structure, now there are many ways of looking at break of structures, right? Some people might look at it as a wick to wick break, or as a body to body break. Okay, but for me, the high probable break of structure is a wick to body break. Can you understand it? Something like this. Like, yeah, let's take it this way. This wick has to be broken by a body closing, like that. Can you understand that?
Yeah.
The wick has to be broken by a body closing. That those are the most high probable breaks of structures for me personally. Okay. Now, yeah, there are times I don't use it that way, but those are the high probable breaks. Okay, those are the high probable breaks. The wick has to get closed, yeah, has to get broken by a body closing above it. Yeah.
Okay.
Okay. Like, yeah, sometimes you can use like maybe a wick to wick break too. Okay, maybe a wick to wick break too, but yeah, it depends. It depends on the situation. Okay, but yeah, with enough back testing, you will know what to use. Okay, something that is high probable for you. Okay,
Okay.
that is personal preference actually. You can see like some people use body to body, some people use wick to wick, some people use body to wick or is wick to body, like all of that stuff. Okay, but yeah, for me, this is what I'm gonna use. And yeah, okay, this is what you want to see. Like simply, okay, in simple words, you want to see a bullish QM and then a bearish QM. That's it. That is what confirms your trading range.
So,
That's it.
if you're viewing this
Yeah.
structure in a 4-hour time frame, so
Okay.
to consider it as a strong high, sorry, um,
Weak high.
a
Yeah, that
strong
is a
weak
weak high.
high,
Okay. A
we need
strong
to
low
go
will always
for,
create a weak high.
okay,
Yeah.
we need to go for the lower time frame, like 1 hour,
Yeah. Now
before
it's
we.
better. Now, yeah, even the 1 hour is okay, but it's always high probable if you get a swing low broken on that same time frame. Now you know about the swing lows, right? Yeah. The 4 hour time frames swing low getting broken.
Okay,
Then
what I
it
mean
is
is,
even more
sometimes we
high
can't
probable.
see any swing in the 4-hour time frame. So,
Yeah, sometimes you can't. So then you can use a 1 hour at least.
Okay, okay.
Okay. Then you can use a 1 hour at least. Now, let me show you a nice example. So let's say we were right here.
Mm.
Let's say we were right here. Now look at this little bit of price action.